Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. Today, I want to talk about some upcoming changes to charitable giving that starts in 2026. Before we get into the details, let me start with a quick scenario that might sound familiar. It's tax season time, so you can imagine that you're entering your charitable donations into your tax software. Over the past year, you donated $5,000 to charities you care about. Maybe your local food bank, a scholarship fund, or a medical mission organization. You type in the number expecting to see your tax bill drop, and nothing happens. The software tells you your donations didn't change your taxes at all. And the reason is simple. It's because you took the standard deduction. For years, that's been the reality of most taxpayers in the United States. If you take the standard deduction, your charitable donations typically don't reduce your taxes. But starting in 2026, this is finally changing. Before we dive into the tax rules, though, I want to acknowledge something important. Most people don't give to charity because of the tax deduction. They give because something matters to them. I know that's true for me. I give to NPR because I appreciate their mission and their programming. I give to my local library system, not only because I use the library extensively, but also because of all the good libraries do for the community. I donate both money and my time to Vision Health International because of the impact in helping people receive ophthalmology care, which is my medical specialty. I'm going on my third mission trip with them this coming May. As physicians, many of us see the impact of charitable organizations up close. We see the patients who rely on free clinics. We see people who benefit from charitable foundations that help cover treatments or medications. We see organizations that provide services that the healthcare system sometimes can't. The tax deduction isn't the reason most people give. But the tax code does try to encourage generosity by making these donations a little bit more tax efficient. And starting in 2026, there are some new rules around charitable deductions that could change how people approach their giving. These changes were established under legislation passed in 2025 called the One Big Beautiful Bill Act. The changes affect both taxpayers who take the standard deduction and taxpayers who itemize deductions. So let's break down what's happening. Let's start with the majority of taxpayers, those who take the standard deduction. Most Americans take the standard deduction when filing their taxes. Historically, if you take the standard deduction, you cannot deduct your charitable donations. There was a brief exception during the COVID pandemic when Congress allowed a small charitable deduction for people taking the standard deduction. At that time, taxpayers could deduct about $300 per filer, even if they didn't itemize. That rule eventually expired. But starting in 2026, a similar concept is coming back. And this time, it's permanent. Beginning in 2026, taxpayers who take the standard deduction can also deduct charitable donations of up to $1,000 per filer. If you're single, you can deduct up to $1,000 in charitable deductions even when taking the standard deduction. If you're married filing jointly, that becomes $2,000 in total. This deduction is in addition to the standard deduction. So you can still take the standard deduction as usual, and then you can also claim this extra charitable deduction. Now, there are some important limitations. First, the deduction only applies to cash donations made to qualified 501c3 public charities. Cash donations include things like checks, credit card donations, online giving, and payroll deductions. However, non-cash donations don't count for this deduction. So things like donating clothing, household goods, or appreciated stock would not qualify under this specific rule. There are also restrictions on where the donations can go. This deduction generally applies to donations made directly to public charities. It does not apply to donations made to donor advised funds or private foundations. Another thing to know that if your donation exceeds the $1,000 or $2,000 limit, the excess cannot be carried forward to future years if you are taking the standard deduction. And of course, you still have to follow the normal IRS documentation rules. For example, any donation of $250 or more requires written acknowledgement from the charity. That covers the changes for people taking the standard deduction. Now let's talk about changes for taxpayers who itemize deductions. The biggest change here is the introduction of a new floor on charitable deductions. Starting in 2026, charitable donations are only deductible to the extent that they exceed 0.5% of your adjusted gross income. That means the first portion of your charitable donations effectively doesn't count towards the deduction. Let me give you an example. Think of someone who has an adjusted gross income of $400,000 and they donate $10,000 to charity. Half of 1% of $400,000 is $2,000. So, under the new rule, the first $2,000 of charitable donations would not be deductible. Only the amount above that threshold would count. In this case, the remaining $8,000 of that $10,000 donation would be deductible. This rule mainly affects smaller routine donations. For people who itemize deductions, it means that the first portion of their charitable giving each year may not provide any tax benefit. Because of this, some taxpayers may want to consider a strategy known as bunching their charitable donations. Instead of making smaller donations every year, it could be smart to instead group several years of charitable giving into a single year. For example, instead of donating $5,000 a year for 4 years, you could instead donate $20,000 for 1 year and then not make donations for the other 3 years. Doing that allows more of the donation to exceed the 0.5% income threshold, which increases the deductible portion. This bunching strategy has already become more common since the standard deduction increased under the Tax Cuts and Jobs Act, and these new rules may make it even more relevant for some taxpayers. Another provision in the new law makes permanent the higher deduction limit for cash donations to charity. Cash donations to public charities can generally be deducted up to 60% of your adjusted gross income. Non-cash donations, things like appreciated stock, typically remain subject to the lower limit, usually around 30% of AGI. If your donations exceed those limits, the excess can usually be carried forward for about 5 years. There's also one more change that affects taxpayers who are in the highest tax bracket. Starting in 2026, the value of itemized deductions for taxpayers in the top 37% tax bracket will effectively be capped at 35%. What that means is that deductions will reduce taxes at a maximum rate of 35% instead of 37%. So, if someone in the highest tax bracket, which is the 37% marginal tax bracket, makes a deductible charitable donation, the tax savings from that deduction will be slightly smaller than it was before. For example, if someone in the 37% tax bracket makes a $4,000 deductible donation under the old rules, the tax savings would have been $1,480. That's 37% of $4,000. Under the new rule, the tax savings would be capped at $1,400, which is 35% of $4,000. It's not a massive difference, but it does slightly reduce the tax benefit for very high income taxpayers. If you're not in the 37% tax bracket, this rule doesn't affect you. Now, even with these changes, there are still some very tax-efficient ways to give to charity. One strategy is donating appreciated investments. If you donate appreciated stocks or mutual funds directly to a charity, you can often deduct the full market value of the investment while also avoiding capital gains tax on the appreciation. Another strategy, particularly for retirees, is the Qualified Charitable Distribution, or QCD. If you're over age 70 and a half, you can donate directly from your IRA to a qualified charity and exclude that distribution from your taxable income entirely. For many retirees, that can actually be more tax efficient than taking the normal deduction. At the end of the day, these changes don't eliminate the tax benefits of charitable giving, but they do change the way those benefits work. For those of us who take the standard deduction, there is now a small new incentive to give. For those of us who itemize deductions, especially those with higher incomes, charitable giving may require a little bit more planning to maximize the tax benefit. But hopefully, the real reason you give to charity isn't just the tax donation. The tax benefits are nice, but charitable giving is really about supporting causes that matter to you and making a difference in this world. The tax code just adds a little extra incentive along the way. Personally, I have been taking the standardized deduction, so I'm excited to get an extra $2,000 for my charitable deductions. I hope this episode helped you understand a little bit more about our tax code and how it's changed in 2026. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast, and have a great week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.